On the morning brief today, Myles looked at what kind of economic data we should be watching right now, and that there's actual data versus opinions about the data that's coming out. And Myles, just before we dig into it, I did want to mention we got the JOLTS data at the top of the hour. Job openings in the U.S. up to 9.3 million in April and in May, I should say. No, in April. It's lagging data, excuse me. Sorry, I was reading a confusing clause here. 9.3 million is what it was, and 1.1 people are competing for every single job opening, which is down from 1.2. So just illustrating that perhaps things are not, there are not enough people competing for the jobs that exist out there, which is something, of course, that we have talked a lot about. But as you talked about, cross currents maybe isn't a word that comes up again as we watch some of the data and the other items, the other, not just economic data, but other types of data this week.
Yeah, and look, I think there's three real stories right now. It's like, what's the deal with the labor market? Why are we not seeing 1 million people per month added back to the labor market when you still have, 7-odd million people out of work relative to where we were in February of 2020? You look at this jobs report data once again, and we see that headline number is a bit disappointing. Also, the meme market continues to be the big story today. Obviously, Clover is kind of taking center stage, but GameStop's up 20% again. They're going to report earnings after the bell tomorrow, so that'll be some nice clarity on what, again, is a fundamental story. And then on Thursday, we get the inflation data. CPI probably going to be the fastest print once again since 2008. That was the benchmark we hit for April's data. It's going to be the May reading on inflation out Thursday morning. But the core CPI number, if it does come through at a 3.4% jump year over year, that's going to be the fastest print for that series since the early 90s. Now, I think what today's JOLTS data that you just discussed, Julie, again, a record 9.3 million jobs open as of April, 1.1 unemployed workers per open job, a level it took us 7 years to get to after the financial crisis. Also, the quits rate continues to accelerate here. So people feeling like they can go get another job if they don't like the one they have. That data really backs up the notion that this is a demand-driven recovery. There is more demand from consumers for goods and services, more demand from employers for employees than the market can provide at this point. That is very significant. I mean, look, the meme market, there is more demand for tradable securities, fungible securities than the market can provide at this point. That is, kind of what's backing up the SPAC trade. It relates to the inflation debate because the inflation debate is why are prices rising at the pace they are rising? If it is demand driven and it is demand spurred by a one-time reopening of the economy, well, the Fed believes that's going to be transitory. Therefore, the Fed does not need to react to this inflation data. If prices are rising because supply is being throttled or supply, cannot keep up with demand because there's, kind of an inadequate ability for the manufacturing side of the economy to get out to consumers what they need, and that there are fears that that demand or that dynamic will lead to higher prices in the future. Thus, you have kind of a cost push spiral upwards. Brian Chung can tell us all about that another time. Then there's something to worry about. But again, the story remains that there is excess demand in the economy, whether that is for labor, whether that is for goods and services, whether that is for automobiles, for housing, so on and so forth. And I think that kind of comes back to the question for all of these main stories. And today's data, gives us a little bit of clarity on that. But I just think these three data points, earnings from GameStop, the JOLTS data we just got out, and then inflation, they really help explain what it is we're talking about on a daily basis in the market. And I think are kind of helpful updates here after the last month of everybody yelling at each other. And look, start next week, we'll go back to yelling at each other again.
Myles, you surprised that inflation fears on the part of investors have subsided?
No, I'm not, because you and I, Sozzi, have debated a long time about what exactly is driving inflation. I think this demand story I'm outlining, the demand story that is, let's call it the official Federal Reserve endorsed version of inflation, is how investors are starting to kind of see the market. And, what is the 10-year yield, right? The 10-year yield is the expected average of the Fed funds rate over the next 10 years. So at 1.5%, that's still what? That's 6 rate hikes from here to there. But it doesn't really suggest that there's going to be a longer term 3%, 4%, a need for that kind of interest rate at the Fed funds level. And again, that kind of backs up this demographic headwind that was the main economic story just a couple years ago. That didn't exactly go away just because we had this one-time pandemic shock.